Okay, everybody, welcome to the final class, Plain Guru University. We just hit record, so I'm just going to kind of go through some things again. This is the sixth and final class. Once again, for those of you who are looking to get case studies, looking to get fully Plain Guru University graduate certified, you do need to turn in those case studies. As I've mentioned frequently before, we do accept, we can definitely set up a quick session with you, review a couple real client projects through a GoToMeeting, and you can receive your certification by demonstrating real client work as opposed to doing the case study. So I just want to make sure everybody knows that that is an option. And then obviously also let's see here, sorry. Then there's also the CPE certification. So if you've attended all the classes, answered the majority or answered the 80% of the poll questions, you can receive your CPE credit regardless of how many case studies you've completed. So there's the CPE credit, which is all about coming to class, answering the poll questions. Then there's the true certification, which is really a function of either doing the case studies or demonstrating to the team here that you've gotten your feet wet, that you have a little bit of experience with the product. As I said before, today's class is on advanced forecasting, and if we have some time left over at the end, we will come back to that topic of talking to your clients. Let's see here. For the section of advanced forecasting, we are going to bring in Taylor Weilich here. I think he's having some difficulties logging into the meeting right now. But we will, like I said, get started here very shortly. Give me one moment. I'm hollering at Taylor through the wall here, and there he is. Excellent. So Mike just asked a great question. What is the deadline for the case studies? And Mike, the deadline is there is no deadline. This isn't college. This is just about making sure that we don't we want to make sure that the people who represent themselves as being Plain Guru certified know what they're doing. So there is no time requirements. You don't get a incomplete if you don't finish the class. It's just when you finally had a chance to get your feet wet and cut your teeth and use the product a little bit, then we will certify you. So without further ado, I'm going to, Taylor, you there?
Yes, I am.
Excellent. And can you, oh shoot, I don't know which one is you. Can you change your name in the GoToMeeting control panel to say Taylor instead of Plain Guru Webinars so that I can know who to switch it to?
Sure.
Okay, beautiful. Okay, so I'm going to switch. So everybody, as I said before, Taylor, as you may or may not know, is our Director of Application Development here. As you may suspect, we share a last name, and therefore we are brothers. But he is the foremost Plain Guru expert when it comes to solving complicated problems and really sort of unlocking the full functionality of the program. And he's gonna take you through some what we call specialized forecasting methods. And I don't mean to cut you off here, Taylor. I'll say some things you're probably gonna say, but obviously he's gonna show you some examples here, and he tries to really simplify those examples and isolate those examples just to show you certain functionality. Your company or your clients may have examples that are nothing like this. They deal with completely different dynamics, but the underlying mechanics that we are leveraging in Plain Guru can be used over and over again in a number of different forms. So like I said, you may not have an example just like this, or your company may not have an example just like this, but don't get sucked into that. Focus on the mechanics of what's happening, understand the mechanics of what's happening, and then you will be able to apply that into your own situations. So Taylor, take it away.
All right. So Christian, you can hear me just fine, right?
Absolutely, yes.
Okay, great. So to kind of follow up on Christian's previous point, the first example we're going to talk about here is really, I'm using deferred revenues on maintenance contracts sold as a specific example, but really the concept that we're trying to illustrate here is how to incorporate timing issues into capturing or accumulating activity on your balance sheet, or recognizing revenue over the as the earning process occurs, not necessarily the month in which the driving event happens. So again, we're trying to demonstrate some timing concepts here. Now, if you've used any of PlanGuru's delivered and specialized balance sheet methods, you'll notice that we have some forecasting methods that kind of deal with some of these timing issues. For trade receivables, we have average days to collect. In other current liabilities, we have the accrued expenses method. So again, we have some built-in forecasting methods that allow you to account for these kind of timing issues, accruals, deferrals, things like that. That said, those delivered methods are kind of meant to meet the vast majority of requirements. But when working with our company or our clients' companies, we're always going to run into situations where we have unique timing circumstances that need to be, I guess, more finely or more precisely defined. And that's really what we're doing here. So I'll get into the example. So in this, this sample business, what they're doing is they're selling maintenance contracts. The idea.
Taylor, I'm sorry to interrupt. Before let's just do a quick. Sorry to interrupt, Taylor. Let's just do a quick poll question before you get in there. I should have done it before I kicked it over to you, but before you get an example. Sorry, hey everybody. If you could just, if we could get, we only got 30-some people here today, so if everybody can answer the poll questions really quickly, that will enable us to keep the lesson going. So even if you don't need the CPE credit, I do ask that you answer the poll questions so we can keep the class moving. And then if you are on an iPad, I don't really even know what this means, but I've been told that you double-click on the poll question you want to answer, and that sometimes works. We're at 97% voted. I am going to close the poll in 5, 4, 3, 2, 1. All right, Taylor, sorry about that. Didn't mean to interrupt.
No problem. Okay, so again, we're talking about a situation where a company sells a maintenance contract, and again, so the revenue has to be recognized, during the life of the contract in even proportions, and a deferred revenue liability also needs to be posted to the balance sheet and amortized down during that earnings process. So, one approach would be to do kind of these calculations, in an Excel worksheet or something like that, and then manually pack these in. Now, that's all well and good, I guess, but it's not dynamic. It doesn't facilitate, I think, a really efficient budgeting and forecasting process. So what I'm going to do is I'm going to show you in the non-financials how we can account for this and other similar timing issues. So I'll go into the non-financials really quickly. So, this is kind of really a driver or a unit driver approach to forecasting, deferred revenues in the related recognition. So I started out by saying, okay, how many maintenance contracts do we sell in any given month, and what's the price of those contracts? So again, the first thing we're calculating is the cash we receive in any given month on the maintenance contracts that were sold. Now, the cash that we receive is very different from the corresponding revenue that we'll recognize from these contracts. But again, the first step was to kind of generate this first calculation, which is what we're receiving in cash per period on these contracts. Now, this is easily calculated using the formula method. So I went in here and I built a formula. I just said maintenance contracts sold. I used these buttons to insert operators and categories. Maintenance contracts sold times the price per maintenance contract, which allowed me to calculate this first crucial step. Now, if you look at the rest of the calculations here, everything's really driving off of these two items here. But the rest of the logic we're building in here is to facilitate the dynamic recognition of revenue, the posting and amortization of the deferred revenue liability. So the next step is I've created this cascading schedule here. So what we're assuming is these maintenance contracts are 4-month contracts. They could have been 3 months, it could have been 6 months, it could have been 12 months. I chose 4 just to make the example simple. So what I'm calculating now is I'm using this cascading schedule to calculate what I'm earning in the current month on all appropriate maintenance contracts. Now, we said the term is 4 months. So what we earn in revenue in any given month is actually the product of the prior 4 months of contracts sold. So to calculate the revenue earned on the current month, so what revenue did we earn on current month contracts sold? So I multiplied cash received on maintenance contracts times our earnings factor. Now the earnings factor, as you can see, it's 0.25. So again, we're recognizing even proportions, 1/4 of the amount per month. Now I'm just going to go ahead and remove those for now, just so we can see how the schedule is working. So as you can see, this 24,995 is being recognized a quarter in January, quarter in February, quarter in March, and a quarter in April. And again, I'm doing this by, again, my first calculation was pretty simple, cash received times the earnings factor, and then each subsequent month of earnings, so revenue earned on T-1, so revenue earned from the prior month contract sold, is revenue earned on the current month. But notice I'm using these prior period radio buttons. So what I'm doing is I'm looking, again, this is where we're kind of introducing this timing element. So I'm looking to the prior period amount, and I'm grabbing that. So the same concept for revenue earned from the 2 prior month sales is revenue earned on T-1, and again, using the prior period radio button. I could have just as easily said, okay, revenue earned on current month, insert that, and said prior 2 periods. Would have been the same thing. So in essence, what I've done is I've created this cascading schedule. Now let me plug some amounts back in here so it looks more like how we would expect it to in real life. So you can see in January, because again, I don't have any prior amounts, all we're earning is what we sold in the current month. In February, we're earning on what we sold in the current month plus the prior month, and so on and so forth. And you'll see these numbers kind of remain static here, but if I update these and introduce some variability, you can see that these numbers start to change. So the revenue earned in the current month is really the sum of the revenue earned from the current and 3 prior months. And again, I'm just using the formula method, adding up these preceding 4 rows. So that's the second step. Now I've captured what I've earned in the current month from this and 3 prior months maintenance contracts sold. So I'll go up to the Revenue and Expenses tab, and I'll change my forecasting method for maintenance contracts. I'll make it a non-financial calculation, and I'll make it a function of total revenue earned. And again, I'll just use a multiply by a factor of 1 here. So now we've linked up the revenue earnings process to our base units here. So that's gotten us kind of 2 of the 3 steps. The last and final step is to get the balance sheet considerations correct. So, cash is automatically going to be fed through what we're earning on the income statement. But that's only half of the equation. To get it right, we have to get the deferred maintenance revenue liability correct. Now to show you how I'm calculating that, we'll go back to the non-financials. So intuitively, the change in the liability for the current month is the difference between the cash we received and what we earned. So in the first month, it's a pretty straightforward calculation. So if of this 24.9, we've earned 6.2, well then the increase in our unearned revenue liability is 18.7. So again, what I'll do is I'll go up to the balance sheet and I'll go ahead and I'll link this to my non-financial calculation, which is the net increase or decrease in the liability. Now, what's critically important here is that we want to use this checkbox, add calculated amount to prior period balance. I'll explain why by going to the non-financials. What we're calculating in the non-financials is not the balance of the deferred revenue liability. And that's, I think, oftentimes where this can get really confusing when trying to do these computations in the non-financials, is that very often we're trying to calculate the balance when really we don't need to calculate the balance. What we really want, the simplest way to do this, is to calculate the change. So what I'm calculating here is the change in my liability, which is, again, the current month inflows less the current month outflows. So what cash we brought in less what cash we've earned. So this radio button here, what this does is it takes the prior period balance, the 18,746, and it adds the non-financial amount to that balance. So in effect, that radio button kind of reduces the required complexity of the calculation. All we need to calculate in here are the changes. So in sum, as you can see now, what we have is we have the correct cash and cash equivalents. We have the correct balance of our deferred maintenance revenue, and we've recorded the correct earnings of that revenue. Now, if we go ahead and zero these out for a moment here, what we should see on the balance sheet is this amount gets drawn down to, well, what should be zero, but it's probably just a rounding of precision. But suffice it to say that over time, our liability is getting amortized down as we earn the revenue. So again, so the example we use here was these deferred maintenance contracts. It really could have been any situation where we have to model the timing aspects of a transaction in a way that's kind of customized or fine-tuned to our company or our client's requirements. So again, I don't think the goal here is to really show you how you would do every situation under the sun, but to give you some insight into how you can build custom computations of these type of timing methods. So, and this could be, I chose deferred revenue. It really could be any scenario where you have these unique timing considerations. And again, I chose to earn these amounts in even proportions. Well, it need not be in even proportions. We can certainly, we could have certainly added additional layers of complexity to make the revenue earned in different proportions. So again, the goal here is just to demonstrate a general concept, which can be applied to any number of accounting considerations or, business scenarios. Okay, so that kind of covered the first topic, which was deferred revenue / custom timing concepts. And again, it's important to note that on our balance sheet, we have a lot of kind of delivered forecasting methods which will deal with some of these timing concepts. But suffice it to say, they're very general, and while they meet most requirements, they can't meet all requirements through an out-of-the-box solution. And that's why, if you can really understand how to use the formula method, how to use these type of cascading schedules, and again, using this add calculated amount to prior period balance, if you can understand those concepts, then that gets you a significant chunk of knowledge that can be used to handle many complicated and individual scenarios.
Hey, Taylor, I was replying to an email for a second there. I mean, did you show them how the prior function can go back multiple periods, right?
Yes, that's a good point. You know, in this scenario, we were only really using prior one, but you can do up to 12 months. So we could grab an amount from the comparable period of the prior year. So this prior period option really introduces a lot of variability into how you can be calculating amounts and what is the basis for that calculation.
Yeah, I mean, Taylor has sort of a little bit, Taylor has like what I would call a waterfall down here where it's, he needs all periods to sum up to get the value for the period. But oftentimes it's just a single line item sort of reaching back in time. You know, do this calculation off of this, you know, take these two variables from 3 months ago, you know, by putting t minus 3 in there, or if you click, sorry. You know, take these variables from 3 months ago, do the math there, put that value in this month. I know, like I said, right off the top of my head, I wish I had an example to talk about, but having the ability to adjust that prior thing up and down and do multiple periods can be very, very valuable. It's something I'm focusing on it because I want you all to remember that functionality is there to look back multiple prior periods, because it's something I think people use a lot. At least we thought they did before we put it in there, because we used to get a lot of complaints. But now that we have it, the feedback's been great. So let's do another quick poll question. What is the best way to charge for a budgeting performance review process? I don't know. You know what, folks? The poll questions might not have gotten updated. The gentleman who does that is on vacation this week, and I forgot. So sorry if these poll questions are the same as what we had last week. I apologize. And if we could get through the poll questions rapidly, we can increase the time we spend in the lesson. We're at 90% voted. Please vote. Yes, I did. I've just been informed that the poll questions were not updated. I'm sorry. Hopefully you're not too offended. I'm going to close this poll question in 5, 4, 3, 2, 1.
Okay, am I back on, Christian?
You are back.
Okay, so the next scenario that we want to talk about has to do, you know, and this may only be, well, the direct example I'm going to use may only be applicable to companies or clients who have multiple divisions, departments, operating units. That said, I think once the example's done, you'll see how the general concept can be applied to a single company or operating unit who's doing their budgeting at a consolidated level. But getting into the specifics of the example, this Omega company that we're looking at here, there's multiple locations. So we have an eastern region, we have a Midwest region, we have a western region. We also have a corporate office. Now, what we're really trying to do here is we want to allocate out overhead expenses to our profit center locations, which are the locations actually selling product, which is eastern region, Midwest, and western region. But we have these general expenses, and from an accounting point of view, we can't parse out these expenses to each of our profit centers, but we rather do that through an allocation. So, very often when we're planning, we want to plan in a way that assesses the true profitability of our profit centers. So in this case, we have this corporate office. We have these overhead expenses. You'll notice there's no revenue, there's no cost of sales in this corporate office. We basically just have G&A expenses. We want to allocate those expenses out to our profit centers. So what we're going to do is we're going to use an allocation process. Now, Christian may have noted in the past that in PlanGuru, we can't link one detailed analysis to another. So for example, if I want to forecast automobile expenses, I can't reach into another analysis and grab a value from, Omega Western region to forecast in my corporate office. So, that is certainly one of the inherent limitations of the application when doing these type of allocations. So what we're going to do is we're basically going to use PlanGuru's Advanced Reporting Added and the Link to Excel feature as a way to allocate costs from one analysis to others. So to start, what I've done here is I've created this corporate overhead allocation class. And essentially what I'm doing here is I'm using the percent of other categories, making it a function of total operating expenses, and making it minus 100%. And the reason why is once our allocations are done, we want this entity to have a net zero P&L. We want to allocate all of these costs out to the revenue that they're being incurred to generate. So again, the goal of this row here is to back out those expenses to get me to a net zero P&L situation for our overhead office, for our corporate office. So bear with me here for a second. Wrong Excel file. Let me just find the appropriate Excel file here. Sorry, bear with me for a moment here. Okay, so again, I noted that because we can't directly link categories from one analysis to another, we're using Excel as an intermediary. In this worksheet, we have you'll see we have two different rows, two different types of rows, or excuse me, three, as I've kind of colored in here. These blue rows, this is information that we're pulling out of PlanGuru analyses through the link to, through the Advanced Reporting Add-in. Now, basically, we're using that information as well as some other information. So we're pulling out total corporate overhead allocation. We're also pulling in the revenues from each of our profit centers, as they will be used as our basis for allocation. I could have used total square footage. I could have used headcount. I could have used any other metric that we're capturing in our front office locations as the basis for my allocation. But in essence, what we've done here is I'm saying, all right, I want to allocate my total overhead based on each profit center's respective share of total revenue. So that's why I pulled the revenue out. I'm calculating the percentages, and you'll see these green rows here are ultimately what we're feeding back into PlanGuru. So when I refresh this file, you can see that this is the information we're pulling out of PlanGuru using the Advanced Reporting Add-in. I've done my calculations here to use to calculate my overhead allocation percentages, and then these are the numbers that will feed into the front office locations as the allocation of our corporate overhead. So let me go ahead and open up one of these receiving locations. So by receiving, I mean they're receiving the costs from the overhead, from the corporate overhead office, using this link to Excel intermediary. Okay, so now what I've done here is you saw in the previous analysis we were basically zeroing out operating expenses. In this front office location, what we're doing is we're pulling in the values calculated in our Excel file using the link to Excel method. So and I've replicated this process for the Midwestern region and the Western region analysis files. So after linking up those three analysis files to my green rows here, in essence what I've done is I've zeroed out my corporate office location, and I've allocated those expenses into each of the profit center locations. So such that when we consolidate all of this information together, in essence, our corporate office can be left out of the consolidation, because once this allocation is complete, it's a net zero entity. So again, I realize there's a number of moving parts here, but if we really break it down, what are we doing? We're using the advanced reporting add-in to pull out information that will serve as the basis for our calculation. We're using that information to generate these dynamically updating allocation percentages. We're using, a formula in Excel and PlanGuru's link to Excel method to pull those costs in from the overhead department. Now, really we're demonstrating a number of concepts here. We're demonstrating how to effectively allocate costs from one analysis to another. We're demonstrating the use of PlanGuru's link to Excel method. Now, I've seen customers use the link to Excel method to, in a different way. Perhaps they have a personnel worksheet that contains 100 employees. They want to allocate those 100 employees to 3, 5, 10 cost centers. The only trick is they want to allocate employees to multiple cost centers. So that's where you start kind of running into a lot of these complexities. And that's where using a well-designed Excel worksheet and PlanGuru's link to Excel method can be really powerful, because it allows us to compartmentalize or contain all the logic involved in a single process within an Excel worksheet, leaving the complexities there and then sucking in the cumulative results from that into PlanGuru. So again, this example is demonstrating a lot of things, but hopefully just seeing these mechanics here will give you some ideas of how you can use this approach for your company or clients. So Christian, should we do a poll question, or should I move on, or what do you suggest?
Yeah, let's do it. Let's just do another poll question. We're actually going to be ahead of the game here, so we won't need to do another poll question until we're done. Like I said, I apologize. Here's the same from last week, but. Okay, I'm going to close the poll in 5, 4, 3, 2, 1.
Okay.
I'll share the results real quick. Sorry, I forgot to do that earlier, but this should be the same results as last week. All right, Taylor, should be back on you.
Okay, great. All right, so we're going to do 2 more examples. Interestingly enough, 3 of these 4 examples that I've done directly relate to forecasting or budgeting scenarios where we have multiple entities. And I think the selection of these examples partially reflects the fact that in most scenarios, the real complexities are encountered when we do have multiple operating units or locations or divisions. That said, our first example was kind of if you don't have a situation or clients that want to budget on multiple operating units, I think you really kind of want to grasp onto the first example, because the basic concepts demonstrated there really have an infinite number of applications. But anyway, back to the specific example at hand. Really what we're talking about is we're talking about eliminations. Oftentimes when we're planning multiple departments, business units, things like that, we can't ignore intercompany activity. It's a crucial part of the planning process, whether it's for planning the cash flow needs of a subsidiary or for whatever reason. We need to include these intercompany accounts and activity in each of our detailed plans. That said, when we roll those up into the consolidated company total or master company, we need to eliminate those intercompany activities. So this example shows you a couple scenarios or approaches for how to perform eliminations in PlanGuru. So you'll see in this example here in my Omega consolidated analysis, I have this intercompany revenue. We want to zero this out. Obviously, there's a corresponding intercompany expense. So on a net basis, we should arrive at zero. But for the purposes of our consolidated reporting, we don't want to include intercompany revenue in our total revenue. So we need to back this out. Now there's two general approaches for doing this. I think which approach you choose is largely going to depend on the number of accounts you have to eliminate and your general preferences. First example is really easy. So I have this intercompany revenue account. I'm going to add a new category to the consolidation. I'm going to call this Interco Rev Elimination. I'll simply use the percent of other categories. I'll grab my intercompany revenue and make it minus 100%. So in effect what we've done is we've backed out the intercompany revenue. Now just to tidy up, maybe what I'll do is I'll add a subtotal grouping. I'll call this intercompany revenue and hopefully spell it right. So now when combined, intercompany revenue nets to zero. Now as I mentioned before, we should have an intercompany expense in here somewhere, and we would just perform a similar operation with our intercompany expense. But I think the general approach is very simple. We use a percent of other categories, we add an additional category on top of our consolidation, which is a key point here, because in a consolidation we have two types of categories. We have categories created by the consolidation process, which cannot be edited as they are the sum of their underlying parts. And then we have categories added into the consolidation, which we can edit like we can any other category. So that's an important distinction. Note that just because you have created consolidation, it doesn't mean you can't add additional considerations into that consolidation, such as an elimination category that backs out intercompany revenue, expenses, anything like that. So that's one example for eliminating intercompany activity. Now, I would recommend that approach when you have a limited number of lines to cancel out during your consolidation, and you don't mind having additional categories. From a reporting point of view, this presentation probably doesn't make a lot of sense. People are just going to want to see a single intercompany revenue account that's zeroed out. But for the sake of simplicity and ease, this might be an appropriate trade-off. The other approach is a little bit more complex, and it's probably a little bit more appropriate for a scenario where you have, instead of 2 or 3 accounts to eliminate, maybe you have 10, 12, 20, who knows how many. Now in this approach, what we're basically using is we're using an elimination analysis. So the concept of an elimination analysis, you'll see this concept in a lot of larger ERP solutions where you have an entity whose sole purpose is to eliminate intercompany activity when it's combined or merged into the consolidation. So using this approach, what we would do is we would add a category into our elimination analysis for each intercompany activity that we want to eliminate. Now, I'm going to kind of combine multiple concepts here, because right now I've manually entered in the amount to eliminate here. What we could do is we could use a similar approach to what we did in our allocation. So rather than manually entering our elimination, we could certainly use the link to Excel method to dynamically update the amounts to be eliminated. So using this approach, I could just, do -1 of this, and that would be our intercompany revenue to eliminate. So I could link the elimination line to our Excel worksheet. So again, we're kind of combining multiple concepts, but suffice it to say that if I go and I open up my consolidation again, after creating that elimination analysis, all we would want to do is we would just want to add that elimination analysis to our consolidation by going to Edit Analysis Setup and just making sure it's checked off in the analyses to consolidate. So those are two opposing approaches to eliminating intercompany activity. Again, I think the approach that you select will again largely be based on how many line items do we need to eliminate out, and your preferences about having separate elimination rows added into the consolidation. So Christian, poll question, or should I continue on?
No, we don't need another poll question.
Okay.
Excuse me, there's only one more poll question, and I'll ask that at the time the meeting's over. So you're good to go. Just keep going and use as much time as you need, and I'll fill a gap at the end.
Great. Okay. So again, this is another scenario where we're dealing with consolidation analyses. Now, a very commonly encountered challenge when budgeting or forecasting by division, department, or individual operating unit is that we have a P&L at the lower level, the location or department, but typically we have a balance sheet at the consolidated level. So when we create our consolidation, off the bat, our consolidation doesn't have our full balance sheet because each of our individual operating units only has a profit and loss. Now, what we could do is we could set up a separate analysis that is only the balance sheet. Now, that's certainly one approach. The downside to that approach is that, in order to accurately forecast our balance sheet, we need to link the balance sheet to the revenue and expense accounts, which drive our accruals, our deferrals. Obvious examples are AR, AP, inventory, any balance sheet accounts that are going to be inherently linked to P&L activity. So in this example, what I want to show you is how to essentially import the balance sheet into the consolidated P&L. And the reason that we want to do that is we want our balance sheet to be dynamic. We want the forecast to be dynamically updated based on the sum of our P&L. So I'm going to use the QuickBooks import to quickly demonstrate this. Not going to walk through the whole process, but suffice it to say, in a consolidation analysis, you can have two types of categories. You can have categories created by the consolidation process, which cannot be edited, and you can have categories that are added into or on top of those consolidated categories to complete this top-level analysis. So what I can do here is I'm just going to go ahead and go to the import utility, and I'm going to use a QuickBooks sample company. Whoops, let's see, is QuickBooks open? All right, bear with me here for just a moment. Okay, so let's see. All right, so just linking to my QuickBooks file here. All right. So we'll progress through the QuickBooks import process. Now, I'm assuming all of you have some basic understanding of how this process works, so I'm not going to go through each step. I'm just going to select one or two periods here because, again, the goal here is to kind of demonstrate how we would import the balance sheet on top of the consolidated income statement. Now, when we get to the Assign Accounts dialog next, as the application's kind of thinking here and interfacing with QuickBooks, one of the things that's critically important is we only want to import the balance sheet. We don't want to re-import our P&L row. Equally important, and I kind of skipped through this, but certainly for QuickBooks users, when we created those individual profit and loss analyses by department, we use the import by class feature. We're not going to want to do that when importing the balance sheet at the top level. Again, because we're importing the balance sheet at the combined company level where our individual analyses, which roll up into the consolidation, capture our P&L activity. So what I'm going to want to do is I'm going to want to go ahead, and again, I'll only have to do this the first time. I'm going to want to go ahead and uncheck my P&L accounts. I kind of like to use the arrow keys and space bar to speed through this. Makes it happen a little bit faster. But in essence, what we're doing is we're delinking the P&L accounts because we don't want to re-import those. We'll end up with duplicate accounts, and it's not going to accomplish what we want to accomplish. So now essentially what I've done is I've mapped all my balance sheet accounts into the consolidation. And don't be surprised if when this completes I don't have balances here, because these QuickBooks companies start in like 2017 or 18. But the key concept here is to demonstrate how you would import the balance sheet accounts on top of your consolidated P&L. And then we can use all of the specialized balance sheet forecasting methods to link up our balance sheet to our P&L. So, previously, if we had created a separate balance sheet analysis, we wouldn't be able to use, the average days to collect method to forecast our consolidated balance sheet off of our consolidated P&L. So that's why I always recommend this approach when you need to forecast the P&L at a detailed level, then forecast the balance sheet at a consolidated level. We create the consolidated P&L using each of our individual departments' locations or operating units, and then we use the import utility to import the balance sheet into the consolidated P&L. So, Christian, those are the 4 examples I have. And again, I realized that most of 3 of those 4 examples were catered to scenarios where there's multiple departments or divisions. And again, I think part of that is just a function of the fact that multi-scenario forecasting, multiple location forecasting is oftentimes some of the most challenging concepts that we deal with.
Hey, Taylor, can you very quickly cover that?
Yes.
And I know this probably isn't applicable to a ton of people in the room, but Taylor's going to bounce through it. If you are outside of the United States and have more questions about it, obviously the team here can help you, but I want, we do say we cover it in the class, and I do think it would be valuable just in case there is anyone out there. So, thank you.
Yeah, Christian, bear with me here for a second. I want to find an appropriate analysis for this. Just another minute, my apologies. Okay. So Christian, you can see my screen. It's live.
Yep.
Okay. So value-added tax, GST. There's any number of terms for what is essentially a goods and services or value-added tax. These type of scenarios can be modeled for in Plain Guru. The first prerequisite is that the analysis needs to be set up to include the VAT computation. That option is selected either during analysis setup or going to the Edit Analysis Setup menu and checking off that the analysis is subject to VAT. We then enter the VAT or GST rate percentage, and then we select our computation method, which is accrual or cash. My understanding, I'm no expert, but I've certainly worked with plenty of customers who have VAT considerations, but my understanding is most scenarios fall under the accrual method. So once the analysis is configured to use VAT, we have this VAT computation sheet. So this will essentially serve as the basis for the computation of our VAT liability. Now the default assumption is that all revenues and expenses are subject to that. But in most scenarios, certain activities need to be excluded. We kind of account for that within this tab. So revenue's not subject to VAT. I can configure this by double-clicking, or excuse me, right-clicking and selecting the select categories not subject to tax. So under the revenue section, I would select what revenue accounts are not subject to VAT, and I would do the same thing in the expense section.
Hey, Taylor, I'm just sorry to interrupt you, but folks, I've been getting a number of messages about people losing sound, and I'll just tell you, I don't know what's going. It's we've been experiencing this problem over and over again. I've been doing other webinars with other companies, watching webinars, and it seems to me that sometimes when you are logged in to GoToMeeting and listening through your computer and speakers, the sound might cut in and out. I don't know what to tell you people besides to dial into the meeting using the phone. People who dial in with the phone have 100%, it always works 100% of the time, but for whatever reason, I don't know whether it's your connection or I don't know whether it's GoToMeeting. It's not something I used to notice in the past. It's something I'm noticing a lot now. But if you're experiencing technical difficulties, then I encourage you to dial into the meeting. Hopefully they clear up. Go ahead, Taylor. I'm sorry.
No problem. Okay, so once we've selected the revenue and expense accounts that are not subject to VAT, that's gotten us halfway there. The next section is that we need to establish the VAT liability on the balance sheet. Now we do that. So let me back up a second. So within the current liability section, under the other current liability subclass, we have a forecasting method called VAT liability. When I select this forecasting method, it will automatically link to my VAT computation. So I don't need to select any categories to link this to. So it picks up the net of the information from our VAT computation sheet. The only option I need to select is when we pay this liability. So it could be monthly, it could be quarterly. If it's quarterly, we select which period the payment is made. So if it's January, the payments will be made January, April, July, so on and so forth. Or we can do select periods. So if for some reason the payment falls in irregular schedule, we can provide for that here. I'm going to go ahead and select quarterly and select March. So now what this does is this method is going to accumulate the appropriate accrual for our VAT or GST payable. It's going to accumulate that up and then pay that down in the third month. The reason we still have a balance here is, again, because we're paying down the prior month's balances as well as accruing for the current month. So that computation in PlanGuru is very simple. We first configure the analysis to be subject to that. We select the general options. We dial in the computation by selecting the revenue or expenses that are not subject to that. And then the third and final step is we link to our VAT computation from the other current liability subclass by selecting the VAT liability method, and we define our payment options. So that's VAT in a nutshell. Very simple, and again, we'll appropriately reflect the cash flow considerations involved in that.
Great. Well, thank you, Taylor. Mike had a question. It says, it looks like it pays in the fourth month, not the third. I don't know, Mike. It looks to me like it pays down in the third month there. You know, it's accumulate, then it doesn't pay it all the way down, but, you know, it still leaves the balance in there. But it looks to me like it is a third and then sixth and then ninth and then 12th month. Okay, well, Taylor, thank you for today. You know, Taylor's always, I always have to badger him to do this, but I have him do this because he's very good at handling these more technical elements of it, and you did a really good job today. So, everybody, from everybody here, thank you. And I will.
You're welcome.
I'll take controls back here. I am going to ask the final poll question here. Once that poll question is asked, you are free to go. In order to get your CPE credit, okay, please do not send me an email asking me how to get your CPE credit. In order to get your CPE credit, send an email to pgu@planguru.com and tell them I have completed the classes. They will then go into the course records, ensure that you met the requirements, and issue your CPE credit. And if not, we'll tell you what to do so that you can get caught up and we can get you that CPE credit. Please answer this this final poll question. Now, for those of you who are accountants and business advisors, I ask you to hang on for a minute if you choose. If you obviously have somewhere to go, you can obviously take off and you get your CPE credit. But I did want to just you know, wrap up this with a quick I don't know if I want to say pep talk, but just some final notes for those of you who are in the business of selling and delivering business services. So if you have a few minutes, I encourage you to hang on for a moment. I am going to close the poll in 5, 4, 3, 2, 1. I'll share the poll results again. Okay, so I'm going to take back the presenter here. So, you know, you all, have probably seen this at some point or another. I flashed this at an earlier webinar, didn't record. But you know, this is that presentation deck. Once again, if you're free to go. If you're operating internally, you're going to want to go. But if you are an accountant or a business advisor, feel free to hang on as I talk for a minute here. But so you should be familiar with this PowerPoint. We have recently updated it, so I am going to upload the more recent version into the PlanGuru University materials section. But it is August, okay? The fall and early winter is budgeting season. So here's your window of opportunity for truly embracing this type of a service and getting a nice I use the term stable of clients queued up, ready to roll into 2015, paying you each month to do these types of a service. Let me go back to this slide. It is, we're getting there. This is even a little, we should probably even, this is what am I doing? I can't edit this, but this orange bar should probably slide out into here for those of you who are new at this, because you're going to want to give yourself ample time to work with all your different clients. But this is, once you get into January and February, you guys are zombies, no offense. I can't. I spend every January, February, and March trying to talk to accountants, and I'm like, they have no interest in talking to me. They have no interest in talking about any of this stuff. I'm sure you all understand it. I'm preaching to the choir here, but in this back half of the end of the summer here, beginning of the fall, beginning of the winter, don't miss this window of opportunity to get on this wave for the next year. Because like I said, once you hit that beginning of the next year, you're going to be just back at this same point next year. So first and foremost, let's jump in head first. I will tell you that we are going to be having some more course materials coming down the pipeline. Course materials in terms of, not course materials, we're going to have more marketing materials. We're going to have a single one-pager that captures everything that's in this PowerPoint and distills it down to a message that you can distribute, whether that be going to a local marketing event, and you can brand the documentation and you'll be able to hand it out, talk about the benefits of hiring you to be an outsourced CFO at a high level. We are also putting together email marketing campaigns that you can send out to your customer base and pitch them on the benefits of budgeting and planning. Maybe not just your customer base. Maybe you sort of reach a broader audience, okay? But in order to become successful at this service, you've got to be able to sort of put that representation up. You've got to be able to market this, and in the coming weeks and months, we are going to be giving you materials to really help you be successful at that. I am not going to go, I will just mention that I did update this PowerPoint, so, I will make sure that the new version gets updated on the website. There are some new slides in here that I think are valuable, and obviously you're all welcome to attend the Providing Outsourced CFO Services webinar, to sort of to hear the full pitch that I do behind this presentation. But like I said, I can't stress it enough. If you want to get together if you want to sort of bring some people in your firm, I don't know, there's all different types of firms out there. If you're a one-person shop, let us know how we can help you get some data in for a client. If you're a multi-professional firm, let's get a meeting together with some of your colleagues. Let's put a game plan in place for talking to your clients about this. We're here to be your resource to support you in all facets of providing outsourced CFO services. So, like I said, we are going to be proactively giving you materials and giving you information and email campaign ideas. But let us. We want more feedback from you on what types of tools and things we can provide to you to help you be more successful at this. One sort of, I think that's about all I had for you. I actually got an email the other day, folks, from, I don't know, and I'm not usually in the business of selling other people's stuff, but I got an email the other day and it made me think. And, I don't know what kind of emailing campaigns you do internally. I don't know what how you reach out to your clients to pitch services and things like that, maybe how you reach out to prospects. But we here at Plan Guru use something called Infusionsoft. And Infusionsoft is a comprehensive CRM / email marketing system that captures tremendous amounts of information. We are sort of in the process of talking to them about how we can sort of take, we feel like a lot of the concepts that we use to reach our customers, are concepts and ideas that you folks can use to break outside of that traditional paradigm. You know, your traditional way of doing business. We want to sort of give you tools that allow you to shake things up and start offering. You know, this is, if you choose to offer outsourced CFO services, you know, you want to put the amount of investment behind it so that, well, I shouldn't say investment. You want to put the time behind it so that you can be good at this and so that you can be effective at it. But you also got to make sure that the message that you're doing this stuff is out there. So I just, like I said before, I mentioned something like Infusionsoft, which is what we use. I'm just going to send everybody this. I'll just put this up on the screen. But you know, it's like I said, it's about getting the message out there. It's about putting together emailing campaigns. It's about letting your existing customers, and forget your existing customers. What if you put together a list of all of the businesses within 100 miles of a certain size and started emailing them that you offer these outsourced CFO services? So I'll send this link to everybody. But I just wanted, I wanted to share this, like I said, that we've had this PowerPoint for a while. We know that these types of services work. So where we're really trying to get better and more defined is where the rubber meets the road, and really help you bridge the gap between, hey, this is a good idea, and hey, how do I actually get out there and talk to my clients about this type of stuff? So like I said, we're going to keep coming out with more stuff. We want your feedback, but I'm just sort of at the last couple minutes here just brainstorming with you in a couple of different ways. So anyway, thank you for attending Playing Guru University. I hope everybody has a great conclusion to their summer and is ready to hit the ground running in the fall. Help us solve that budgeting crisis that we have here in the U.S. and everybody and make more money. Everybody, your clients make more money by making better decisions, and you make more money by offering your clients a more comprehensive service. So, have a great day. Oh boy, actually, you know what? I sent this link to. Let me just. Sorry, I wanted to resend that link. If anyone was interested in that CRM platform I was telling you about, that Infusionsoft we use, basically runs our entire business. I just resent everybody the link. So anyway, have a great day. Have a great rest of the summer, and let us know how we can help.